Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk to you. It's been a few weeks since we last spoke, and it's some interesting stuff going on in the financial markets.
Yes, the stock markets, the way I've observed it since their peak in, I think, about December, we have 2 or 3 really good days and a few bad days, but overall it seems to be kind of a creep downwards. Not enough to panic people, but definitely kind of a trend. Is that what you're seeing?
Yeah, I think that's a good assessment of what's going on. I mean, there's really, one funny thing about the market is, if you look at the people who are most actively trading the market, they're not really concerned at all. And for proof of this, I would say take a look at Fidelity. They've got an interesting link on their website, or do a search, go to Google and put orders by Fidelity customers, and this will come up. It'll show you a rank of all the top 30 stocks that have the most orders going to them. And it'll even show you how many of the orders are buys and how many are sells. And consistently, Tesla has been at the top all year. And you'll even see the triple Qs. They don't want to buy the QQQs, which is the NASDAQ 100. They want to go on leverage. And that's number 7 today. NVIDIA's on the list. A triple SOX ETF is number 10. GameStop, Rivian, some extremely speculative stocks. So, and I've been monitoring this for the past several months, and not once, even with the selling that we have seen from time to time in the market, has there been more sell orders than buy orders. There's always more buys than sells. So when the market's been down, these active traders are trying to buy. Now, the problem is they're trying to buy the fad stocks of a year and a half, 2 years ago, which are, a lot of them are now lagging the market and are things I wouldn't put a penny into. Rivian, for example, being one of them. That's this electronic car company that doesn't have hardly any revenue, hardly produces any cars. It was trading at $180 in November. Now it's at $40. But people are fascinated with the electric cars. And last week, we saw Robinhood go up over 20% a day. AMC did the same thing. And GameStop went from about $80 up to $180 in a 10-day period. And again, this is an indication to me that the people actively trading the market are very bullish, always playing the same stocks that were the past fads, while the reality of the situation is we're in a much different stock market environment than we were in the past. The S&P 500 fell below the 200-day moving average, down about 14% from the opening of the year till the March low, and then bounced, but it's still sitting right on the 200-day moving average. It's only 10 points away from it. So to me, that's not a very strong market, and that's where the strength is in the broad market. If you look at things such as the ARK ETF, it's so far down the 200-day moving average, it's going to be a very long time before it gets above it, if ever. So a lot of stuff is frankly in a bear market. I define a bear market as something trading below that moving average and staying below it. And many things have been doing that now since last summer. So that's the reality. It's either the Russell 2000 also is trading at the moment at 200. The 200-day moving average is around 215, and it's been below that really since right after Thanksgiving. Again, that's bear market action. When something stays below the moving average, the 200-day moving average, for more than 3 months. This thing's been below it for 4 months now. So it's a slow motion bear market, one in which you do get rallies. They ultimately don't lead anywhere. And then you make a leg down, then you rally again, you make a leg down, you rally again.
Mike, so we have a slow motion bear market with rallies that don't go anywhere. What do you see from here?
Well, I mean, the good news is that there's always a bull market somewhere. And I'm speaking generally of the broad market, the S&P 500, the NASDAQ in particular being weaker than the S&P, and all these speculative stocks, they just get pops. But there's, you look at something like Robinhood, it's at $12. The 200-day moving average is probably around 30. It hasn't even been trading for 30 days, but it's just not going to go anywhere. So look for things that are trading above the 200-day moving average that are outperforming the market. There's a simple saying: if you want to beat the market, get in what's beating the market. Don't just buy something because it's up on a bounce. So what's beating the market is obviously commodities. And gold and silver, I think in particular, are in a good position to start to rally at some point in the next couple of weeks. Gold had a big pop earlier this year, up to almost $2,000 an ounce. Up to almost $2,100 an ounce. It went through 2,000. It's now trading around 1925, but it's in a very narrow range with like 1900 as support, 1950 as resistance. It's been trading like that for about a month. I think it's likely to break 1950 and then have another rally. But even better is that mining stocks tend to go up more than gold when gold goes up. And not only that, but they lead the action in gold. So when the mining stocks don't perform as well as gold or go down when gold goes up, that's a sign that you're facing it's a negative divergence. You're going to get a bear market or at least a correction. That's what happened from 2011 to middle of 2012. But now the mining stocks are outperforming gold. I use something simple to measure this, the GDX divided by GLD ratio, and it's been trending up now since December. And stocks like Newmont, which I do have a position in, made a new high, all-time high just last week. So to me, that's exciting. Buying stocks that have recently made new all-time highs in a sector that's outperforming the market. I'd rather do that than jump on something like Robinhood or AMC when it goes up 20% in a day and it's been falling for months on end. And now, all those things are fading off that return. And energy stocks, I would say, fit that category. And the thing about it is people keep thinking, oh, these are temporary moves in commodities. Gold went up because Russia invaded Ukraine. But, in past times when gold has made tops around geopolitical events, it just gives up all the gains. It's not doing that. In oil, you get bearish news on oil, and oil prices don't really fall, and energy stocks simply ignore it. So, for example, last week, President Biden said that he was going to use the emergency oil reserves to try to make the price of gas go down. And since that announcement, the price of Exxon has only gone up. So that is just an indication of how powerful the underlying trend is when it comes to commodities, energy, and precious metals. And the reality is these things have not just been going up because of the Ukraine war. They've been going up now for well over a year. the inflation everyone talks about today and sees at the gas pump, at the grocery store, really began over a year ago. It was over a year ago, in fact, that the Federal Reserve was saying inflation's coming, but it's going to be transitory and go away, so don't worry about it. But then by November, in October of last year, it became clear that it was not going away as they predicted, and it simply accelerated, and now it's gone up even more. You know, in the Ukraine war happened, and now after the last Fed meeting, which I think happened after our last conversation, they were claiming in that meeting that they could raise rates up to 3% in 2023, and they're predicting inflation would go down and go away afterwards. So they're doing the same game of saying, you know, one day inflation will go away. We just have to be raising rates a little bit. But they were wrong last year on that, and I think they'll be wrong again because history shows that inflation does not go away until the Federal Reserve raises the federal funds rate well above the rate of the CPI inflation. And they're not going to do that anytime soon because if they jump the Fed fund rate up to 8%, the whole stock market would crash and the economy would go down the toilet with it. Instead, we're in sort of a situation like the 1970s in which the Federal Reserve will raise rates slowly over years, but it's going to take years for them to get the Fed fund rate above the inflation rate. So this underlying inflationary trend is going to last for years. And that's what I'm investing in. And frankly, I think, you know, that's why these things are outperforming the stock market, why energy stocks are outperforming the stock market, why gold stocks went up in the first quarter while the S&P 500 went down and the NASDAQ went down even more and the ARK ETF went down even more than that, and even Bitcoin went down because Bitcoin really just trades with the NASDAQ and doesn't have anything to do with being some sort of defensive play at all.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, some people say Bitcoin is a better hedge against inflation or bad times than gold. What's your point of view?
Oh, they're completely wrong. And I want to, when I say that, I want to the people listening, I want them to think about what I'm about to say. Ignore the thing that I said they're wrong, because the way the media works, especially the internet, people like to hear things that confirm their views, and then if they see or hear something that doesn't, they get angry. And then they tune out what is then said, even if there's a few tidbits that can be useful to them. So I just focus on what I'm about to say and apply it. Okay, when you analyze a market, all markets have some sort of relationship to another market that you can actually measure mathematically. It's called a correlation. So, for example, the NASDAQ and the S&P 500 do tend to go up and down together. And one will go up more than the other, but they do tend to go up and down together. The NASDAQ's more volatile than the S&P 500. And if they were moving in lockstep with one another, then the correlation would be 1, you know. But if they're trading completely opposite to one another, then they'd have a completely negative correlation. So, for example, if you buy a short ETF, I'll use the example of ARK. So that ARK ETF became very popular, and then a lot of people started to question it, and some guy actually came out with an ETF that allows you to short it. That ETF is designed to go down when ARK goes up, almost perfectly. So if you do this same sort of analysis with Bitcoin, what you find is that Bitcoin does not go up when the NASDAQ goes down. It does not really go up when the U.S. dollar goes down either. In fact, it has a extremely closely correlated relationship with the NASDAQ. Out of all instruments, gold, commodities, energy, oil, Bitcoin is most closely correlated with the NASDAQ. Its strongest trading relationship is with the NASDAQ. So if you think about what happened in March of 2020, which was the last time there was a significant crash type event in the stock market, the NASDAQ, the S&P fell over 33%. The NASDAQ fell even more, and gold fell about 10%, but Bitcoin crashed completely. It fell over 70%, and then it rallied with the stock market. And if you just look at it now, from Thanksgiving till through the first quarter, Bitcoin fell. When the stock market fell, Bitcoin fell with it, and then it has bounced as the NASDAQ has bounced. So what this means is that when the NASDAQ has another decline, Bitcoin is almost certain to decline with it. It will not go up when the NASDAQ goes down because it has never done that before. And it has no real its relationship of going up when the dollar goes down either. So it's not a safe haven instrument. It's really the equivalent of buying calls on the NASDAQ. You know, instead of buying the NASDAQ, someone who wants to really speculate can buy Bitcoin instead and they think, oh, I'll make more money. And that's really what people use Bitcoin for. They don't use it as a store of value. They don't use it as currency or money in any meaningful sense. Instead, they use it as an instrument of speculation, and that's how it should be understood, because that's what the mathematics of Bitcoin's trading relationship to other instruments demonstrates it is. So when people make all these claims and predictions, I completely ignore them, and anyone who disagreed with the first statement I made, they should do the same sort of analysis, measure the correlation of Bitcoin to all these different assets, and see what the reality is of it, and then decide from there how should it fit in their portfolio. It should, and if they want to use their portfolio, they have to understand it is not a safe haven instrument at all, and to treat it as such is almost certain to lead to portfolio destruction, especially if you have a large amount of Bitcoin making up your portfolio. I have none, and I never will put any in my portfolio because I don't need it, because I own other positions that I'm happy to be long in that aren't as volatile, that pay dividends, and so forth. I don't want to buy something that can crash 90% when the S&P falls 30%. I want to own something that pays dividends, and when it comes to stocks, they represent ownership in companies. So I've had several stocks that I own that the companies got bought out, and when that happens, they have to buy my shares because they represent ownership in the companies. Nothing like that ever happens with crypto coins because they represent ownership in nothing. They're virtual currencies, and that's all they are.
Mm-hmm. So I'm sure you have the same opinion of NFTs, which exist only on somebody's computer. I mean, you're one power failure away from losing that $10,000 cartoon.
Yeah, I think it's silly. I mean, I read a lot of books myself, and I don't like to buy the Kindle version of these books. I mean, I have in the past, but I don't like to do it because when I do that, I don't feel like I own anything. And what if the Kindle Amazon thing shuts down one day? Then I have nothing. Or the stupid device breaks and then I decide not to buy another one. Then I lose access to these things I've spent money on but don't actually own.
Mike, always a pleasure chatting with you.
You too. Looking forward to the next conversation.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. We'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.